All right, y'all. Waka Flocka created a lot of conversation when he made this statement about life insurance.
When I know I had all the millions and I didn't even have a credit card, the dumbest. I was like the dumbest person ever. I used to spend money on everything. Man, please. Please. I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. I never lose my money, ever.
And when I tell you, people hopped on that train and they were pumping life insurance. Life insurance is your own personal bank. It's what the rich do. If you're not on it, you're not that smart, or maybe you're just a poor person, or whatever the case might be. It's not what you think. Where did Waka Flocka get the idea of using life insurance to become your own bank? Maybe it was this guy here.
The average person buys life insurance in order to get the death benefits, so when you die, your kids get a check. Nothing wrong with that, but that's how it's marketed to you. Wealthy people use life insurance as a tool.
So wait a minute. So he said there's nothing wrong with that, but it's really like, oh, you poor, ignorant soul, you have no idea how us wealthy folks do it. And in reality, most wealthy people did not get their wealth by utilizing life insurance, and they certainly do not use it as a personal bank. And I'll break it down point by point.
In order to create their own bank, and they operate on different rules. One is to bypass taxes, the other is to create more income. So if I were wealthy, here's an example. I get an insurance policy, I put $40,000 into that policy.
First off, where's the $40,000 going to come from? 70% of Americans do not have $1,000 in case of an emergency, yet we're talking about $40,000. Where did it come from? Did it come from an insurance policy? No, these insurance policies have to be funded from somewhere. Just because you open an insurance policy does not mean magically your account is going to grow and make you a millionaire. So let's see how he explains this process.
The insurance carrier pays me 10% in interest.
So the insurance carrier pays you 10% in interest. He used that as an example. Whenever you use examples, you can't have pie in the sky numbers. Show me an insurance company that will pay you 10%. They don't exist. I challenge him to post which insurance company does that. If an insurance company pays a high dividend, where that dividend comes from is the fact that you are overpaying your premium. So that's just like you walking into an Apple store and they say to you, okay, you can buy this Apple phone for $1,000 and we'll give you a $10 rebate, or you can pay $1,500 for this phone here and we'll give you a $15 rebate. Which one are you going to pick? Now that's an easy choice. You're going to pick the $1,000 phone. The problem is when an insurance agent is talking to you about this concept, you don't have the benefit of being able to compare. So they show you a policy and they say, look how great this is. It gives you this rate of return without telling you that you overpaid, just so they could refund you a portion of that and make it like you have received a huge rate of return. The other thing you should know is that Consumer Reports says that the average whole life insurance policy, which is what he is talking about, earns 1.5%. 1.5%, that's a far cry from this 10% scenario that he is proposing. Let's continue.
$4,000. I earned $4,000. Instead of having to pay taxes on that money, I'm going to take it out as a loan at, let's say, 5%.
All right, so let's talk about that. So again, it's not 10%. Let's say it's what Consumer Report says, 1.5%, which means instead of $4,000, you have more like $500 in order for you to utilize in this process to start a business and to make more money. Let's continue on.
Then I'm going to use that $4,000 to buy an asset that's going to produce me more income, and then I'm going to pay back that loan plus interest back to my insurance policy.
Okay, so he said a lot there. All right, so first off, the reason he didn't say you could take 40,000 or 35 or 30,000 or 30 of the money that you put in is because in the first 10 to 15 years of an insurance policy, the kind that he is representing here, a cash value life insurance policy, your money is locked in jail. You can't access all of it. You know why? Because the person who sold it to you as well as the company that offered it to you are both extracting their profits and their commission out of that insurance policy over that period of time. And then that's why you don't have full access to your money for 10 or even 15-year period of time, because your money isn't intact. If you try to take it out early, you put in 40,000 in year one, you are lucky to get back anything. Year two, maybe a little bit something more, right? It's not until that 10, 15 year mark that you actually can break even, not even earn anything. Yet he's making like it's this magical thing that you are missing out on because you're not part of the elite wealthy class. The other thing that he says is you take this money out as a loan and you pay that loan back into your policy. Now what that sounds like is this: you're paying the interest back to yourself, but you're not. You're paying it to the insurance company that borrowed you your own money. So what does that sound like? Does that sound like you're lending yourself money if you have to pay for it? Or does it sound like someone else is lending you money if you have to pay interest back to them? So that's the wordplay that a lot of salespeople will do, say, oh, and you pay this money back into your insurance policy, which is technically true, but they don't tell you where that money is going. It's not going into your pocket. When you pay that interest back, it's going to the insurance company's pocket.
Now my insurance policy just made more money, my asset is generating more money, and I'm rinsing and repeating and doing it all over again. I'm my own bank. Wealthy people operate on different rules with insurance.
Oh, wow, that sounds slick, brother. But when you really think about it, what if you would put your money into another investment vehicle? Would you just have the $40,000 that you put in 10 years later, or would you have double that or something more? Right? So this is my problem with this kind of video. I mean, it's filled with bravado and we're doing something that you guys don't know about. When in actuality, there's an easier way for you to make money that doesn't include life insurance. But guess what? In this video, on the right-hand side of this Instagram post, it shows an email address of how you can get in contact with them for life insurance, right? So when you see these videos online, they're very self-serving because it's just like a person who possesses a hammer and a hammer only. Everything looks like a nail to them. So it's going to be like, hey, you need to buy your kids school clothes, life insurance. You need to buy groceries, life insurance. You need to get your car fixed, life insurance. Keep in mind, a salesperson is only going to share with you those things that they can get paid from. So they're not in the business of giving you information so that you can go and excel and build wealth from. They're in the business of giving you information in hopes that they can benefit from it downstream. All right, so that's an example of one of the individuals, but there's tons of them. Some of them aren't just as obvious as what I pointed out here. It's a little bit more hidden in terms of their motive. Let me explain.
Here's with most life insurance contracts, they will not allow you to touch all of your money all at the same time, especially at the beginning.
All right, so wow, that's exactly what I said. So if I'm watching this video, being someone who has an immense knowledge base when it comes to life insurance, I'm saying, wow, this guy is on the up and up. He's sharing with you exactly what I did that the other guy before did not, which is the first 10 or 15 years of that policy, you do not have access to all of the cash unless you want to pay a huge surrender charge. Okay, well, maybe he's going to just continue to be up on the up and up. So let's see what happens.
Beginning. So the surrender charges, a lot of people say, well, life insurance has a lot of charges. A lot of times in life insurance, those charges only apply if you surrender the policy.
Oh man, you disappointed me, right? So what he's saying is that, just like I did, is that the first 10 or 15 years has tons of fees, and that's what people complain about. But magically, once you get that 10 or 15 year mark, it's nothing to worry about. Those fees go away. And what he's talking about is the surrender fee. But you know why it's no longer there? Because the life insurance company has extracted everything that it needs to extract in the way of fees over that 10 or 15 year period of time in order to recoup the cost of establishing the life insurance on your behalf, as well as recouping or getting whatever profit that they want to get out of the policy, as well as paying the commission to the person who sold you that policy. They got all of the money because there are fees inside of that life insurance policy each and every year that you're paying, and it has finally reached a level where they're saying, hey, we got what we came for. Now, if you decide to take your money, you can have it. But again, the cash value will just equal what you put in 10 years ago. How does that sound like a type of bank that you can really utilize to build wealth? Wouldn't it be better if you had $40,000 up front to put into a business? Wouldn't it be better if you had $40,000 up front to invest versus having to take it to pay insurance companies' profits, insurance companies' commissions, and everything that goes into the life insurance process? Let's continue on.
Sure, if he's going to borrow in the first year, second year, third year, not advised to do that, because you want to treat a life insurance policy like a bank or a checking account.
Well, I think what he means is that you don't want to treat it like a bank or a checking account. Hence the reason he said in the first couple of years, you don't want to take money out of there. And that was a key part that Waka Flocka left out as well, is that let's say he was able to put 2 or 3 million away. Having access to that money early on and taking money out would almost always cripple your life insurance policy. And what happens is if the policy no longer exists, then the tax benefits no longer exist as well.
When money has significant tax advantages, we call this the laser test, LSRT. So anybody asks you, hey man, you should put your money away here, put your money away there, put your money, does it pass my laser test?
All right, let's talk about your laser test. So liquidity, does this cash value life insurance have liquidity in the first 10, 15 years? You said to yourself, it doesn't. Safety, right? You have to find a life insurance company that has financial strength and stability to make sure they can pay out, and you make sure that you have your cash value that you put in the first place. Because if the life insurance company goes under, depending upon the state you live in, you may be able to get 100,000 back in cash value. But what if you had 2 or 3 million in it, like Waka Flocka said? A rate of return, a nice rate of return. I think he said decent. Would you consider 1.5 decent? In the tax advantage, life insurance does have some tax advantages, but you can't let the tax tail wag the dog. That's extremely important. And there's a lot of other factors to consider. But he's not the only person. And last but not least, there's another gentleman. And he started off by telling his story.
To now own a $2 million mansion, a couple of Lambos, 422 units of real estate without needing to necessarily go to the bank for the down payment or any of that. I borrowed money from an untraditional place.
All right, so first off, my problem with this is it was positioned as if it was inspirational. I have this, I have this, I have that. However, right, what is made to make you believe is that he has this because of this alternative vehicle that he has. He's building his own bank. And he has this because of life insurance. But again, you can go out and buy a life insurance policy. This is magically going to fund itself. You have to have an income stream in order to put money into the life insurance policy. So did he get the $2 million house and the Lambo and things of that nature from having a life insurance policy? Or is that proof that it's a lucrative product that you're selling? Okay? So because keep in mind, that's kind of like if Mark Zuckerberg said, the reason I'm a billionaire 100 times over is the fact that I've established a Facebook account. That's not why he's worth $100 billion. He's worth $100 billion because he got everybody else to sign up for Facebook. And that's exactly what folks are doing when it comes to this life insurance, right? Where are they making their money? Are they becoming millionaires because of the life insurance? Because they purchased it or because they got everybody else to purchase it?
Using any of my own money, using other people's money.
All right, so he said without necessarily, with a person who's trained in a background in sales, I understand where there's a lot of wiggle room in what people say. So when you say not necessarily having to go to the bank, doesn't mean that you didn't go to the bank. It doesn't necessarily mean that you used your life insurance for any substantial purchase or down payment for real estate. It just means that it was available, so you thought it might have been somewhere that you could tap into. But the other thing he said, I didn't use my own money. I'm using somebody else's money. How is that different from a traditional bank loan, ladies and gentlemen? How is that different? When you go to a bank, you borrow somebody else's money, you pay interest. When you borrow money inside of this life insurance policy, like you said, it's not your money, you're borrowing it from somebody else and you pay interest in order to pay it back. Help me, help this make sense to me. I think why it may not make sense is because people have bias. So here's what I mean by that.
I guess I should have told y'all this. I actually own a financial firm.
Oh, it makes sense now. So now we see that the Lambos and the multi-million-dollar home and the 400 plus, doors of apartments that you own, right? Again, is that a result of owning life insurance or selling life insurance? Because if it's a result of selling life insurance, you need to be honest, right? You need to be pitching people to becoming a life insurance agent, or at the very least, maybe owning stock in a life insurance company that sells it to other people versus telling people, hey, if you buy these Jordans, you're going to jump as high as Jordans. That makes no sense. But I think it's starting to make sense why this information is so prevalent. One, if you look at all the 3 examples that I gave, each one of them made mention to the fact that they sell life insurance. And being a life insurance agent is different than being a financial planner. Because if you're a financial planner, you're looking at the overall picture. So you have more tools than just a hammer. Life insurance could be a tool for certain things, investments, you name it. So I think it's time for somebody to give you a different perspective who's actually a financial planner. Because clearly they're careful to tell you they're not, because they understand the importance of knowing that you're not providing a robust solution. You're just treating everything like a nail. So if you enjoyed this video, you want to see more like them, please like and subscribe. And until next time, be good.